Now, who here's business has been affected by the CCCFA over the last year? So pretty much every dealer or finance company in the place should have their hand up on that one. Well, it could have been much worse, and I think one of the reasons why it got a little bit moderated was this our next speaker here, Lyn McMorran from the Financial Services Federation. Probably unknown to some people, but you guys do a heck of a lot of work behind the scenes on making sure people can keep on lending money and selling products and so forth.
That's the whole point of it all. Yeah, we try.
Right, so we will let you go on your way. There you
Perfect.
go.
Thank you. Awesome. Right. Okay. Okay, I won't go through what we'll cover because you'll find that out very shortly as we go through, and we don't have an awful lot of time. The Financial Services Federation, I'll just quickly fill you in as to who we actually are. We've been operating for about 57 years. We have 3.6 FTE, full-time staff, 89 members, and our members touch about 1.8 million New Zealanders. Who we are is we are the industry body representing responsible non-bank lenders. So our members are non-bank lenders and credit-related insurance providers. The reason that the organisation exists is because back 57 odd years ago, some of you might remember, there was a finance minister in New Zealand called Robert Muldoon, and he came up with a brilliant idea to stop inflation. And that was to restrict access to consumer finance, because if you did that, then people couldn't spend money, and that would curb inflation. So his idea was that all lenders back in the day should invest at least 5% at the time of their assets, their lending book, into government stock, so they couldn't lend it to consumers. So of course they all started lending to businesses instead. But by the time the 1984 Labor government came in, he'd actually ramped that up to 30%. So 30% of a finance company's book couldn't be lent to consumers, it had to be put into government stock. They got together and formed the body that is now the Financial Services Federation. So who are our members? We've got a lot of them branded motor vehicle providers, motor vehicle finance providers. You can see there Toyota, Mercedes-Benz, BMW, all of those. We've got MTF, very happy to have MTF and CFS as members. Provident, Autosure, Protector, the credit-related insurance providers are all members of ours as well. But we also have a group of the large finance companies like UDC that lend across the board to business and to consumers. We have a lot of the credit unions and building societies as members. One of the gifts, I guess, from the CCCFA from our point of view is that there was a need for information. There was a need for information when COVID struck, and there was a need for information when CCCFA struck. And so there are silver linings in everything, and from our point of view, it meant that we've grown our membership considerably in the last 2 or 3 years. But not necessarily because we, in the way that we perhaps might have wanted to. It's more people coming to us to find the right source of information to be able to carry on doing their business. Because, and I'll get to that, the penalties for not doing it are really, really high. So what we do is obviously we try to grow and retain our membership, our members understand the value of wanting to be a member and coming back to us every year to pay their subscription, which is what keeps us going, is obviously something that's really important to us. We actually do, because we talk about being the representative body of the responsible non-bank lenders, we're really careful about who we let in. So we have quite strict compliance around and a due diligence process about who we let in. And we do help some of the smaller finance companies to actually understand what they need to know to be compliant, to help them to get to the standard that we would expect of them to be a member. But that is all about improving the credibility of non-bank lenders, and I think a lot of the initiatives that the government put in place, like the Business Finance Guarantee Scheme, as an example, as a response to COVID, forgot the fact that there is a non-bank lending sector, and actually we're really important, 1.7 million New Zealanders, or 1.8 million, however many it is. And so, you know, our customers are just as important as those of the banks. We build the capability and knowledge of the industry, and in particular at the moment we're working on a project to actually build a credible qualification in consumer credit that will go on the NZQA framework, and we will be offering that through our members and also to non-members, anybody who's interested in doing consumer credit responsibly. And also, of course, we're looking at maintaining a strong and credible brand. And that's trying to tell the positive stories about non-bank lenders, because you'll probably notice that if non-bank lending is mentioned at all in the media, it's generally in a not very positive way. It's usually about somebody doing something dodgy. And of course, we have a proactive approach to government. So the question for this presentation was, is there life after the Triple CFA? I tend to think of it as the gift that keeps on giving. I've been around now for, I think, 3 iterations of the Triple CFA, which is probably suggesting to me that it's time to move on. But yeah, there was quite a substantial review of the Triple CFA in 2015. You might recall that, I think, was actually done, it was initiated by Simon Bridges when he was Commerce and Consumer Affairs Minister back in 2015. So that introduced the lender responsibility principles, which was all very principles based, and it basically said you shouldn't lend money to somebody who can't afford to repay, or who might end up in substantial hardship as a result of this loan repayment. So it made total sense. It didn't tell you how you should do that, but it made total sense to say you should not lend to somebody who would end up in substantial hardship. Now, when you think about it, it would be what a responsible lender would do in the normal course of events anyway. So it wasn't a huge deal, but I mean, it actually put into law that you shouldn't lend money to people who can't afford to repay it, which is eminently sensible. In 2018, Chris Farfoy, who was then the Minister of Commerce and Consumer Affairs, announced at our conference that he was going to review it. He was going to review the Triple CFA, and this is what we're now currently trying to deal with, so it's taken all that time to get to this point. But he basically came out and said, yeah, he could still see that vulnerable consumers were being exploited by dodgy lenders, and they were getting themselves into debt spirals that they couldn't get out of and all of that sort of thing. And our argument to that was, well, then why on earth is the Commerce Commission, who's the regulator, not enforcing the law? Because it says quite clearly in the law, if the person can't afford it, you shouldn't lend it to them. So anyway, we had that argument. Sadly, we didn't win that argument, because you can see where we went to. We went far too far. We ended up in a really, really prescriptive regime. I mean, we agreed with some of the changes that they put into the Act. We didn't have a problem with, for example, payday lenders having a cap on the interest and fees that they could charge. We didn't have a problem with putting a definition into the law of what those people actually are. So they were people who were charging interest rates of 50% per annum and more. Now, some of those payday lenders had been charging 800% per annum. They are now capped at the rate of 0.8% per day per annum, which is actually 292% per annum. It's actually 300% if it's a leap year. So, yeah, some of those changes were changes that anybody sensible would say, yes, of course, you should do that. Then it went berserk, and it went completely crazy. And where it went really badly wrong was in the regulations. And the regulations are so prescriptive that effectively what they were saying is that rather than providing protection to consumers who might be in vulnerable circumstances, you were actually being asked to treat every single customer that walked through the door as being vulnerable. You were basically suggesting that people didn't have the ability to make their own decisions about how they would actually adapt their lifestyle or adapt their expenses to make sure that they could meet their commitment that they've made by taking out a loan with a finance company to buy the vehicle that they wanted to buy. What you had to do as a lender was actually ask them exactly where all their money came from and where all their money went to. You had to get information to verify that, which basically came mostly from bank statements. And so as soon as you saw on the bank statement that, oh, here they are, they're having avocado on toast every weekend, you would have to actually ask them questions about how many times a week did they do that, and could they stop that expenditure in order to be able to meet the commitments for your loan. And, you know, not at all giving the consumer any credit for having any brains or any sense of their own to be able to work out, well, maybe I shouldn't buy so many avocados on toast because I really want this vehicle. So particularly stupid. And, you know, we were consulted throughout this process. We were consulted over and over and over again, and as Richard said, you know, in the background, we're writing submission after submission after submission to government, to select committees, to the ministry that is doing all the policy work, to the Commerce Commission issuing guidance, and all the way through we're saying this is a really bad idea. This is going to limit access to credit. It's going to push the vulnerable people into the hands of the really dodgy people. And it's, but it's also going to affect normal and average consumers who would just normally walk into a dealership, say, I like that car, I would like to talk to you about finance, give you their information and assure you that they can meet those commitments and everything looks pretty okay, and they can walk away and drive away in that vehicle. The granular level at which you had to go into their expenses just meant that was going to, we know that it blew some of our members' process to get to an approval from 3 to 4 hours to 3 to 4 days. And that would be because the customer was having to come back and back and back with information to be able to get that deal over the line. And then we would end up with a situation where the number of applications that were declined increased by about 21% in the first 3 months of the CCCFA coming into force. So the really interesting process is that, we were consulted. We were given any amount of opportunities to say what we thought. We told them what we thought. We said, this is a really stink idea, guys, don't do this. And they went ahead and did it anyway. They just didn't listen. They were, I believe, completely captured by the consumer advocacy sector, which is our friends at FinCap, the Citizens Advice Bureau people, the Christians Against Poverty Salvation Army, all of whom do a fantastic job and with whom we work quite closely. We're not saying anything against them, but what they probably don't always understand is the fact that they only see people when they are in trouble. They don't see the vast majority of people who take on loan commitments and meet those commitments and don't have a problem. Because if you don't have a problem, you're not going to talk to a financial mentor. So anyway, we were listened to. We were consulted, but we were not listened to. And then we had things like, the myth that went round, and I heard Minister Clark, who is currently our Commerce and Consumer Affairs Minister, stand up and say 1 in 5 people think that they are in positions where they have harmful debt. Well, that is a stupid statistic, because if you go and ask 1,000 people, have you got debt? And you say yes. Do you think it's harmful? Is it stopping you from doing things that you want to do? Well, of course it is. If I didn't have a mortgage and I didn't have a car loan, I could travel overseas. But I do have a mortgage and a car loan, and I'm going to actually pay those. I mean, it's a really, really stupid question, and it's the way in which that question is framed that sort of leads you to get an answer that is only going to validate the silly position that you're standing in at the time. And then, Minister Clark, when it all turned to custard, and within literally weeks of the CCCFA changes that came into force as at 1st of December last year, Minister Clark announced this review, and he's going to start walking it back because it wasn't working. Strangely enough, everything that we said was going to happen actually did happen. And it made access to credit really hard. Consumers really hated it. Never mind what we thought of it, the consumers hated it because they hadn't been asked did they want to be treated like twits every time they went into a dealership and asked for finance. So, he tried to stand up and say, oh, well, it had to happen because lenders were doing it wrong in the first place, or it's all about global conditions because there's inflation and high interest rates. That's what's inhibiting access to credit. No, it's not, Minister. It's actually your silly rules. So he then ordered the Council of Financial Regulators, which is RBNZ, FMA, ComCom, Department of Internal Affairs, people like that, to go away and do a review. And they did a review and they came and talked to us and we said, actually, it's turned out to be exactly as we said it was going to be. It's stupid. It's not working. Consumers don't like it. It's slowing access to credit, etc., etc., all the things that we said were going to happen. And funnily enough, when they talked to people, they found that that's exactly what was happening. It wasn't just us telling them that. They were hearing it from everywhere. So he then, in March, announced some fantastic changes to the affordability regulations, where he was going to exclude having to count savings in your affordability assessment. So if somebody said, we save $200 a week, you had to assume that they did not have $200 a week to help pay for their loan repayments. So he said, I'm going to make that change. I'm going to make it clear that if you use a benchmark, you don't have to use bank statements, but if you use bank statements, you don't have to use a benchmark, but if you use them, you've got to take into account everything that they tell you. And then he clarified the use of there's one exception in there that says if it's obvious that the person can repay this debt without suffering substantial hardship, you can sort of waive all the requirements. But that was the example they gave was somebody who was on a $300,000 income applying for a $10,000 credit card. It would be obvious that they could repay that. It wasn't obvious if it was somebody that you've dealt with for 20 years who keeps coming back to you every 2 or 3 years and buying a new vehicle from you, who's never missed a payment, never missed a beat. That was not obvious that that person could repay without substantial hardship. So those 4 changes came into force in July. He's announced a few more that are trying to deal with this whole idea of what is a fixed expense and what is a discretionary expense. So if it's discretionary, you could assume that the customer could perhaps let it go in order to make the loan repayment affordable, and you could treat the customer with a bit more common sense. But the problem with that is you've still got to ask them what is discretionary and what's not. So you've still got to ask these really intrusive questions. You've still got to write down the answers. The person said they would stop having avocado on toast every week. And then what happens if they don't and they get into hardship and the Commerce Commission goes after the lender? Because the biggest problem is, of course, that for the lenders, all their senior managers and directors are personally liable for getting this wrong. They are on the hook for up to $200,000 each if they get it wrong. So if they're taken to court and found to be in breach of the law, they could be personally liable for this $200,000, and they can't insure themselves or indemnify themselves, get directors' liability insurance or anything to cover that. So they are trying to walk it back a bit. I think the changes that the Minister announced in August that will come into effect in March of next year will make it a bit better. It will make it slightly less onerous. But I still don't think it's going to actually stop the need for these really granular questions that you're going to have to ask of borrowers about, what they see to be discretionary. Because, what I think is discretionary, what you think is discretionary could be 2 completely different things. So do you take into account things like gym memberships? Because how easy is it for the customer to get out of that membership? And therefore, if they can't get out of it, therefore it's not discretionary. It's still fraught with drama. The National Party have announced that they want to do some more work on the CCCFA if they become government, but they're talking about doing things like making it easier for banks. And of course, we're quite opposed to that idea on the basis that actually that is really anti-competitive, and there's actually a law in New Zealand against anti-competitive behaviours. So, we're not terribly thrilled about that either. We just think let us go back to how it was. But wait, there's more. So that's CCCFA in a very, very brief nutshell. What else have the government got on their minds at the moment? What they're doing at the moment is they are introducing a conduct licence for financial institutions. And some of our members are going to be caught by that piece of legislation. It captures registered banks, registered insurers and registered non-bank deposit takers. So our non-bank deposit taking members and our insurance members will be captured by what we call COFI. And they will have to have a licence for their conduct, a fair conduct program. They will have to make sure that you as dealers who are selling their products know and understand their fair conduct program and are ensuring fair customer outcomes. And look, don't even ask me what any of that means because we don't actually know at this stage. It's all very fluffy. And you will have to understand their fair conduct program and ensure fair customer outcomes. The whole suite of insurance law in New Zealand is up for review at the moment. So the poor old insurers are being hammered by CCCFA, COFI, and now the review of insurance contract law. The non-bank deposit takers are being dragged into the deposit takers bill, which is going to make the Reserve Bank their supervisor. They're going to have things like a depositors guarantee scheme thrust upon them and all sorts of other things. We're going through a massive review of the AML CFT legislation at the moment. That is going to make some substantial changes to AML and the customer due diligence process and all of that sort of thing. So that's, again, another thing that keeps us awake at night. And you might have seen a little bit just recently about this consumer data right open banking announcement that the government made just earlier this week, which is around consumers actually owning their data. Now, we think that that's a great idea because the banks hold on to this data and they don't want to share it. And the reason they don't want to share it is because they don't want you to know about it, because if you know about it, you might be able to offer them a better product. So that's coming. And I guess, in short, what that means for us is it keeps us employed. It keeps the 3.6 of us, well, actually, there's only 2.6 of us at the moment, we're recruiting. But yeah, it keeps the 3.6 of us writing submissions and hoping like hell that we'll get listened to. So, happy to take any questions.
Fantastic. Thank you so much for that. Now, any questions for Lyn from the crowd? We've got a microphone needed down the back there, Deborah. Run away.
I can do that.
My short legs.
We kind of touched on it earlier on that a lot of this triple CFA stuff came from Australia, is that right?
It did, but so we used to, or Australia used to look at us and think, oh my goodness, you've done such a good job with your credit law because you haven't gone too far, you've made it principles-based, not prescriptive, and then we turn around and we've gone completely in the opposite direction. Now they're looking at us and laughing because, their consumer credit law is not even as restrictive as ours anymore, so yeah.
It's government getting us laughed at by Australia.
Yeah,
right.
It's not fun.
Question down the back here.
Just in regards to the qualification that you're working on, is that part of the New Zealand Certificate in Financial Services?
No, it's not. It's separate to that. The New Zealand Certificate for Financial Services is the one that the financial advisors actually need under the law. It doesn't do anything for us in terms of consumer credit. So ours will be at the same level as that. It'll be a level 5 New Zealand certificate, but it will be in consumer credit, and we're actually developing it right now. So it will cover all the legal aspects that you need to know, so anti-money laundering, privacy, all of that sort of thing. It'll go into triple CFA stuff in detail, and it will talk about dealing with hardship, dealing with those sorts of things that the current New Zealand certificate just doesn't do.
Does that mean that you, as a broker, you'll be able to be on the FSPR?
I think what we need to do is some more work around that. The point of actually developing it is because our members who are finance companies want it for their people.
Right.
I think for the brokers who deal in this space, as opposed to the people who are investment advisors or financial planners or whatever, it's probably a much more relevant qualification for you people. So I think we have to do some work around getting it accepted at, if it's at the same level on the NZQA framework, then why? What difference does it make? So yeah, we're working on it.
Okay, thank you.
Hi. It's a really good question. Not at this stage, and I guess that would be also something that we'd push back on. We've been lucky, I think, so far that you've escaped that. But yeah, so the question is whether or not dealers or agents should be licensed, or is there any push towards getting them licensed? There isn't at the moment. I guess from our point of view. I guess from the point of view of a finance company, it might be quite a good idea because it puts some onus on the dealer and agent, whereas at the moment, all the responsibility sheets home to either the insurer or the finance company. And it's the directors of the insurers and the finance companies that are on the hook if something goes wrong. I guess we have been lucky to have got away with it for as long as we probably have. I think when you look at things like, when they first introduced the Financial Advisors Act, for example, you were captured. And it was my predecessor at FSF who got you out of that regime. Otherwise, everybody who works on the floor at Harvey Norman's on a Saturday, for example, who signs up a credit agreement, would have had to have been an authorised financial advisor. It could happen, and I guess what we would need to do is consider it at the time. And what would be the parameters around that, and what would they be expecting from you? Would you have to go off and get a qualification? Would you be treated in the same way as a financial advisor, perhaps? So we'd have to think about, what that might look like. In and of itself, being registered or whatever is not necessarily a bad thing, because then at least you know who the audience actually is. But it's just what are the conditions around the licensing that they might put around that, and as I say, what they require you to do to get one. So yeah.
Excellent. Anything else for Lyn? No? Fantastic. I think we'll send a box of
There's
beers down the
one down
back,
the
because
end.
I was one over here, sorry, missed that. All right. Run, Deborah, run.
Need a second mic.
Hi, my name's Alicia and I am contracted as a broker to a company called MJM Finance. It's just two of us, but as two of us, do we have to register as an FAP? Because there's no clear guidelines on the website for us of what to do.
It really depends on whether you provide advice.
Well, we kind of do and we kind of don't. I mean, we're
Yeah.
registered FSPs or FAPs, but there's no clear guideline if we're just at level 5s or anything like that.
I'll start by saying I'm not a lawyer. I'm a banker by trade, so don't quote me on this. But if you are providing advice in any way, shape or form, you should have a financial advice provider's licence. We were able to get an exemption for consumer credit providers, so the people in the finance companies themselves dealing directly one-on-one. And the reason we got that exemption from the financial advice law was because the CCCFA covers what they do in terms of any advice around their product and its suitability for the customer, their disclosure, making sure that the customer's making an informed decision. In the case of a broker, if you've got a suite of providers that whose products you use, the chances are, if you start saying that product is better for you than that product, provider A's product is better than provider B's, you're stepping over into providing financial advice, and therefore you need a financial advice provider's licence.
Okay, well that makes sense then. Thank you.
You're welcome.